Are the lockdowns going to kill our property markets and the economy? Well, the lockdowns are weighing heavily on consumer confidence and business confidence, and the continual conveyor belt of negative messages, they're getting people down, aren't they? Yet despite the onerous lockdowns, currently our property markets are performing strongly. Having said that, things are going to change moving forward. So in today's Property Insider video, Dr. Andrew Wilson and I will give you some clarity on what's going on. If you want to keep up to date with what's happening in our property markets, please subscribe to our YouTube channel and click the little bell icon so you can be notified each time there's a new show. It doesn't really matter whether you worked last month, whether you walked around the local park, or you just sat and watched the Olympics for hours every day. Either way, chances are your home or your investment properties, if you own them, made more money than you did. The average house price is rising faster annually than the average national wage, and the latest data from Dr. Andrew Wilson's My Housing Market shows some striking combined yield and growth figures for the last 12 months around Australia. At the extreme, the most expensive properties around Australia are rising more than $1,000 a day over the last 3 months. But what's happening now with the lockdowns? And are the lockdowns going to kill our property markets and the economy? That's what we're going to chat about today. So I'm looking forward to my regular Property Insiders discussion with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of our housing market, because we're going to talk about what's really happening on our property markets and what's ahead. Hi, Andrew.
Yes, hello, Michael. And really, it's tedious is the wrong word. It's certainly a sobering environment we're in, particularly obviously in Victoria and New South Wales. And we're certainly starting now, particularly in New South Wales and Sydney, to see the consequences of a prolonged lockdown. Of course, Sydney went into shutdown a year ago through April and May, but it came out of the lockdown. And perhaps looking at the numbers back then, they weren't as sobering as they are now. And I guess that what that means is the outlook is very uncertain at the moment in terms of when we will get back to any sense of normality. And as I said, Michael, it's now starting to show in the data that's coming through.
Well, the lockdowns are weighing on consumer confidence, on business confidence, but there's also the continual conveyor belt of negative messages in the media, Andrew, and that's starting to get many people down. Now, despite the onerous lockdowns, the auction markets did well. But
Yes.
Before we look at those, let's just have a look at what's happening to listings and to sales. How are they surviving these challenging times?
I think what we understand, firstly, from last year's lockdown environment, Michael, is that really it was a nuisance to the market rather than a fundamental change to the underlying drivers. I mean, there's plenty of pent-up demand, plenty of energy yet to be released in our housing markets. And once lockdowns did conclude and normality reigned again last year following lockdowns, we did see a release quite quickly of buyer and seller activity and energy. And of course, as you mentioned before, prices have continued to rise very strongly on the back of that catch-up market, particularly in Sydney and Melbourne. But the longer it goes, of course, we do see vendors postponing for a longer period of time their decision to sell. And with fewer properties available to choose from, and also restrictions on the capacity to inspect properties, particularly in Melbourne. You can still inspect properties in Sydney, but it's a much more onerous process in Melbourne. And of course, most people would like to physically inspect a property before they purchase it. So what we see again is the longer lockdowns go, the fewer new properties come into the market and the fewer sales are conducted. And we're seeing that quite clearly in Sydney. New listing numbers are down quite sharply since went into lockdown at the end of June. And also new sales numbers have also started to fall quite sharply. Numbers are around about where they were a year ago, but when we see the same environment in Melbourne as Sydney. But I think the interesting comparison is when we look at Brisbane, which of course hasn't had the severity of shutdowns that Melbourne and Sydney has had, and really its markets just kept on keeping on. And I guess that's the whole point. Now, the question is when and if, and fingers crossed that sooner rather than later, the lockdown finishes, will we move back into that sort of catch-up mode that we've had previously?
We know that buyers are sellers and sellers are buyers. So why would you put your house on the market at the moment if, firstly, people can't inspect it or inspections are limited and you can't go off and inspect your next home as well? That's the difficult decision. Do I buy first? Do I sell first? So it's just too hard for some people to make a decision at the moment with all the uncertainties, Andrew.
Yeah, look, that's right, Michael, and we can understand that. And the longer the shutdown goes, we start to have other factors involved in the housing market. And of course, that's the economy. People do get concerned about their outlook for their employment. And we're not going to have the same, I guess you might call it large S in terms of stimulus packages that we had last year, it appears. So less support, but I'm not sure that that was a significantly contributing factor to the rebound. Some analysts have quite questionably stated that it was the JobKeeper allowance that aided the uptick in the housing market. I'm not sure a lot of people who were on JobKeeper were eligible for loans. Please take note of that. But at the end of the day, it does work its way into confidence. As you said, the never-ending negativity in the media plays a role in this, as people are becoming less certain about the outlook. But I still think that we have that pent-up energy factor, which will see our housing markets rebound, because this is a nuisance and an impediment rather than something that's impacting the underlying fundamentals of our housing markets. And I think people really realise that, Michael. And once we get out of lockdown, I think we'll see markets picking up again. But the data shows that fall in listing numbers and sales numbers now, which is expected, it does become more problematic the longer the shutdown goes on, because people do then start to really reevaluate their decision-making in terms of buying and selling property.
It's an interesting paradox, because while our economy is faltering because of the lockdowns, and not long ago, 16 million Australians are unable to leave their home, you found that rental markets are performing well, rents are moving up, and in fact, house prices are shooting the lights out, Andrew.
Yeah, look, that's right, Michael. Rental markets, we're seeing a number of factors obviously impact rental markets, underlying longer-term factors. First is in the house market, we're still seeing a reduction in vacancy rates. So we're seeing lower vacancy rates and higher rents for houses. We know that there's some perhaps justification for people that are looking for more room, that they're looking more for a larger property. And also because we've got more people working from home, there's not the same need to commute to the CBD. So people can look for perhaps living in areas which aren't as well serviced for transport into the CBD. But what that's done is increase demand for houses. The credit squeeze on investors over the last 4 or 5 years has reduced the supply of investment properties, particularly houses. And that means that in a number of capitals, we have a shortage of house rentals. Obviously, the shutdown environment, what that does is it stops the churn, not so much the fundamentals for the rental market, but it stops the churn. In other words, people postpone their I'm moving on, or I need a bigger place, rental decisions as they do with their buying scenarios. But we're not seeing any impediments to rent or implications for rent at this stage. And we really didn't see that last year either, Michael. But we are starting to see some trends based on COVID in the rental market in relation to migration pattern. We've interestingly seen vacancy rates higher in Melbourne than the other capitals, and also some downward pressure on house rents in Melbourne, whereas all the other capitals are certainly looking at a shortage of house rentals and also higher rents. And I think a lot of that is that we know that there's been an exodus of migrants out of Melbourne, particularly into southeast Queensland. And so in a way, it's sort of robbing the Melbourne housing market and putting more pressure on the Brisbane housing market for rental stock.
Well, looking at the chart you've provided us, gross yields are low at the moment for houses, and that's understandable. Rents haven't moved up much, but house prices have moved up significantly. But when you add the total return together, in other words, the capital growth and the yield, boy, are property markets all around Australia performing well.
The overall return, annual returns, including rental returns and capital growth, are well above double figures in most capital cities. And this is quite extraordinary considering that what the returns on other asset classes are and how low inflation is. This is quite a remarkable result. It won't last, of course, once the price energy is dissipated that's driving house price growth at the moment. We will get a flatter yield outcome. But it's interesting also that in some markets, not only are we seeing strong prices growth, we're also seeing strong rental growth as well. So it's really not a perfect storm, but returns on assets, on residential assets are working in the same direction at the moment. And usually yields will fall as prices rise, but some yields, particularly the Brisbane yields, are holding quite steady at high levels, comparatively high levels at over 5%, Michael, in terms of yield. And you add that to a near 10% return, annual return capital growth at the moment, and that's 15% return with all those tax advantages. So there'd be some happy people out there at the moment who are engaged in residential investment.
Well, as I said at the beginning, some people's houses and investment properties are doing better than they are with regard to wages. But over the weekend, it was really a tale of two cities with the auction markets. Quite a dichotomy. Sydney did well and Melbourne faltered a little bit because of COVID.
Yeah, interesting data. We need to look a little closer at the data, Michael. I think we had the lowest number of properties put under the hammer in Sydney since October last year. This is a very low number. Again, it reflects that listings aren't coming through. And we're now well into where the decisions were made in lockdown. Of course, auction markets tend to be backward looking in terms of their listing numbers because it takes around 6 weeks or so from that decision to actually get the property under the hammer. But so we're now seeing, I guess, the real sentiment of the market in lockdown in Sydney, and those listing numbers were very low, but buyers are still quite active and happy to engage in the market, Michael. And in Sydney, as different to Melbourne, they can inspect properties. There's perhaps more of a online purchasing in Sydney. So the clearance rate held steady at 83%, which of course is a very good result. The other point we need to look at is the withdrawal numbers continue to fall. And that means that those people who are in the market at the moment are not being surprised by lockdown and withdrawing their properties. So it was a good result from Sydney, considering I think a lot of that clearance rate is because we've seen a reduction in withdrawal numbers, but also a shortage of properties available has kept that clearance rate higher. Now, Melbourne was a different story, Michael. Melbourne had fewer listings again, but obviously not the sort of drop that Sydney has had. Melbourne's listing numbers were still very high for this time of the year, for August. But when we look deeper at the numbers, and of course, Melbourne's clearance rate fell quite noticeably down to 66%. But when we look at the numbers, Michael, closely, there was a 40% of the reported auctions were withdrawn from sale. And that's obviously a reflection of the lockdown environment. And that's what we saw last year during the depth of lockdown at the beginning, when those that had booked their auctions in prior to lockdown decided to withdraw the auction on the day because of that. And that's why we had that very low clearance rate, Michael, because of the very high withdrawal number. So withdrawals aren't a property that's actually gone to the market. They've actually decided, no, I'm not going to sell it today now or offer it for sale today. So it's still counted as part of the mix, as part of the offering of auctions. So technically it's counted as a non-sale or the relationship between a passed in and a sale. So it always acts to, the higher the withdrawal levels are, always acts to push the clearance rates down. And Melbourne typically has a very low withdrawal rate, Michael, around about 5% on average. So to have 40% withdrawn is remarkable. But we saw that last year. And this is, of course, just a product of lockdown. So if we took the withdrawal numbers away and just looked at the properties that were offered versus the number of sales, the clearance rate was around 80%, Michael, even if we distribute the withdrawals as being half sales and half passed in. So we will see fewer auctions coming into the market as the restrictions continue. Hope that's not too long. But the lesson is clearly last year, and that's a good thing because we're not getting the ridiculous predictions of house price crashes that we had, much to the embarrassment of a lot of people a year ago. I think that we'll see our markets pick up again. But look, let's hope that is sooner rather than later. And it's not about the housing market. It's really this time about if we can still maintain a robust economic recovery going forward.
Well, the economic cost of the lockdowns is expected to surge beyond $20 billion if Greater Sydney's stay-at-home orders extend beyond August, it's been said, and they are going to. So, yes, it'll be interesting to see how that plays out. Having said that, I'd like to take up one issue that you mentioned a moment ago about property against other asset classes, because while properties performed well, there's always that old argument, property versus shares, but the share market keeps nudging new highs, as are the property market, but you can't compare apples to oranges, can you?
No, it's interesting, of course, and I'm not anti-share market. I think everybody should have a balanced portfolio in terms of their investments, and shares are part of that, as property is. The shares versus property is an age-old argument, and it certainly has its advocates at both ends of the spectrum. But the share market's up 11% this year, Michael, which is a very good result. The Dow's up 17% this year, so it's still an underperformer compared to other share markets. And if we go way back to that peak of the markets, which was an international peak prior to the GFC at the end of 2007. Stock markets have only increased. The Australian share market has only increased by around about 15% since then, whereas Sydney and Melbourne house prices are well over doubled in value in that period of time. And it's not just houses. It depends when you take your measurement, of course, how these things pan out. But if we look at purely the comparing share markets over that period, the Dow, the US share market, has also well and truly doubled in its value compared to Melbourne, to Australia's dribbled up around about 15 to 20%. So there's some work to do for the Australian share market to catch up perhaps with other asset classes. It's doing it at the moment to some degree, but a little slower than others. And we hope that we don't get the shakeout that we had previously. I think that's another good thing, Michael. We haven't had a shakeout in our share market as a result of the shutdown as we did a year ago. So that, I guess, that's a good sign of confidence in our local investors, and that's to be applauded and well done.
Yeah, so even though the outlook remains uncertain, interestingly, personal finances, they seem to be holding up. The Commonwealth Bank this week, Australia's largest bank, explained that only 0.4% of its home loan book, 6,800 loans, are currently in deferred. That's well below the 150,000 at the start of the pandemic last year. And apparently retail spending is still remaining high. I found in lockdown, Andrew, there are two sort of days: the days that you get some online shopping coming into your house and the days the postman doesn't knock on the door.
Yeah, that's right. Yeah, I'm in that world too, Michael, believe me. Yeah, look, I think it's, again, the other point is that we can think also in terms of mortgage holders' positions, is that with interest rates having remained flat over the last year, and obviously going to remain flat for a long time, even more so now with this current environment. Again, it's been it's been a convenient excuse for those that were quite mysteriously predicting higher interest rates next year. Go figure that. But people's balance sheets have improved also over the last year, Michael, because of the growth in house prices. Equity has exploded, really. So that means their real positions have improved, whereas their costs and incomes have continued to grow, whereas their mortgage costs have remained stable. And we have the data this week will show us wage growth for the June quarter, which will be very interesting, Michael. And of course, we have the unemployment numbers for July. Again, we'll start to see some trends as a result, not from the wages. The wages will improve from a record low level, but they won't be anywhere near the level, even in a semi-post-lockdown environment, that would have been even close to justifying higher interest rates. And I think the economists who predicted that need to either start reading Economics 101 and start looking at the real drivers of inflation and a wage spiral outcome, rather than just throwing a dart at the board and picking a number. But as I said, that data will be quite interesting. But obviously going forward, we will start to see an impact on our economy in terms of unemployment and wages growth as a result of lockdowns, particularly given Australia's largest economy, Sydney, New South Wales. The outlook is not good at the moment in terms of getting out of shutdown anytime soon.
No. So we'll catch up again next week.
Yes, we will.
Dissect the data. Thanks for your time, Andrew.
Yeah, thanks a lot, Michael.